Man, a spate of economic data out this morning that, for the most part, points to slowing inflation, growing caution. The debate over whether this is enough to put the Fed on pause, that's going to continue probably through the next round of data. So we've got a whole nother month before the FOMC meeting in May. But here's the thing. We saw personal income climb 0.5, personal spending though only 0.2. So consequently, savings soared again, 4.5%. Folks, savings rate was 3% back in September. It's obvious that American households, they're bracing for tough times. And then there's Powell's favorite inflation gauge, personal consumption expenditures. The headline was 5%, core 4.6%, both slightly below consensus. What Powell says we should look at, though, that core service ex housing, that declined to its lowest level in 7 months. On balance, I was really surprised the market didn't open higher. And even though we're up now, I'm shocked that we're not even higher. But then again, this 2023 rally has been something of a mirage, right? I mean, let's be honest. So-called FANG, Facebook, Alphabet, Amazon, Netflix, Google, and M&T, Microsoft, NVIDIA, and others, they're up. In fact, they're up huge. They're overwhelmingly the top. They're the only reason the market's up. The other 492 stocks in the market, they're actually down 1%. So you got those 8 stocks up 5.5%, the rest of the market down 1% coming into the day. Now, here's another way you can look at this. The top stocks in this market, and catch this, the top 15 stocks in this market have gained $1.8 trillion in market cap. The rest have lost $21 billion. I want to bring in now Crossmark Global CIO Bob Dahl. And Bob, I read your note that central banks have tempered their hawkish rhetoric, but has that helped to alter your cautious approach? Because you've been somewhat cautious with this market.
Not really, Charles. Look, the Fed has the banking thing now, and that's causing them to pause a bit. They probably have one more to go, but inflation, you just reported, is 4.5, 5. It's nowhere close to 2. And on top of that, you are pointed out that consumers are a little cautious. We're going to have a good first quarter GDP, but I think earnings estimates are still too high. And now I look at my screen, I see trailing 12, the S&P 500 selling at 20.5 times earnings. Forward earnings, which in my view are too high, 18.5 times. Those multiples make sense if inflation's 2 or 3, but not 4 or 5. So I'm still on the cautious side.
Okay, it's interesting. Fundstrat, which is Mike Lee's shop, overwhelmingly bullish, right? But they put out a pretty interesting piece saying back-to-back quarterly gains in the stock market have marked brand new bull markets in the past. So I guess you're saying this would be an anomaly, but it's still a bear market.
I think so. Now, maybe I'm looking too much into the rearview mirror, but it's hard for me to think that Fed raising rates from 0 to 4 3/4 in a year doesn't have more negative consequences than a couple of banks going under. I think it will have an effect on paring economic growth. So I think growth will slow after this stronger than expected, I admit, first quarter.
Bob, you mentioned earnings already. That's been a bone to pick for a lot of folks, that they're just simply too high. But let's just say, what if these companies do find a way to come in and, for the most part, beat? Would that signal something? I mean, listen, the companies, they've been cutting costs. They've been letting people go. The top line, yeah, there's not much they can do about that. But there's a lot of engineering between the top line and the bottom line.
For sure. And look, 2023 S&P 500 earnings last summer were $250. Year-end, $230. Now $220. My guess is when it all's finished, it'll be closer to $200. And then 20 times that is 4,000. That's where we are. Hard for me to get really positive here. On pullbacks, I'll buy. I think this is not going to be a year where the Bulls or the Bears are happy. First 6 weeks of the year, as you know, Charles, we frustrated the Bears. Then for a few weeks, we frustrated the Bulls. Now we're frustrating the Bears again. I think this is going to oscillate a bunch and make a lot of people unhappy. Any core positions that you would add to here, or just mostly the idea is take what the market gives you and be nimble? So on balance, I'm trimming the 8 and buying the 492, back to what you argued a few minutes ago. So from a sector standpoint, I'm trimming tech into strength and buying lagging financials and energy stocks that have high quality and good cash flow. Bob, that's why you're one of the legends in the game. I appreciate it. Thank you so much.